Every winter, pandemic permitting, global Wall Street makes the trek to the Swiss Alps for the World Economic Forum, an organization started 42 years ago by Swiss engineer and economist Klaus Schwab to gather leaders of business, government, and academia to, as he put it, improve the state of the world. He spoke at the beginning of the conference about some of the thorniest issues today.
Hotspots of this geo-economic remodeling are high inflation, increasing interest rates, and growing national debt. This is particularly hurting low and middle income groups. It is exacerbating societal fragmentation.
As Klaus Schwab says, we have some global economic issues to deal with, starting with at least the possibility of a recession, something that Citi CEO Jane Fraser told us she anticipates, though it may not be a bad one.
What we are seeing is different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but short of anything crazy happening geopolitically, and this time last year we wouldn't have predicted what happened in Ukraine, you've seen the tails come in. So you've seen the over-optimism from some about soft landings and the economy's doing well, but equally you've seen the severe case downside also coming in. I think the general view in the States, certainly one we hold at Citi, is we expect to see a mild recession, largely driven by the painfully persistent service inflation. It's coming off, but it's still pretty high, and we do expect to see central banks continue tightening as a result. But the vulnerabilities that amplified previous recessions around the world are not present. You know, banks are in very good shape, consumer balance sheets are in good shape, corporate balance sheets are in good shape. And I think that omens well for a mild recessions when they come, rather than ones that we have to be worried about.
Jane Fraser sees a rolling recession around the world, but maybe, just maybe, it won't roll to Europe after all, after German Chancellor Olaf Scholz told our editor-in-chief John Micklethwaite that he does not anticipate a recession in Germany this year. And Gary Cohn, he's now vice chair of IBM, agrees with him.
I thought that the risk to Germany was really the energy situation going into the winter, to the extent that we had a very cold winter and they had to start rationing energy and they had to cut back industrial Germany to keep people warm. I felt that that was a really tough situation potentially. We're now deep enough into the winter and we sort of know where we are. We know what's in reserve and storage. I think Germany's going to get through the winter fairly easily with energy, and I think they're going to continue to power through this. So I'm in agreement with the Chancellor.
All of which led to a somewhat more positive outlook at the World Economic Forum than some had anticipated, as observed by Mary Callahan Erdos, responsible for investing $4.1 trillion at JP Morgan Asset and Wealth Management.
I would say the tone here, having come here for the past decade, is less depressed than it often is, which is a good sign of hope of what's happening out there in the world. Having come off of the most difficult year for a balanced portfolio, 60-40, whether you were in stocks or bonds or anything in between, it was pretty rough sledding. And so I think everyone's happy that that's behind us and looking forward. And the job of what all of us at JP Morgan do is work on advising clients through the cycle. And so we're going to have lots of boom and bust cycles. You've had a few people on today talking about it. And I think the most important thing is to stay focused on diversification, opportunity, not getting wedded to any one thing that looks like it worked in the past. It may not work in the future. And so we're spending a lot of time on that. I mean, one of the things that really manifested itself through COVID was the problem of home country bias, which creeps into almost everybody's portfolios. And you have to be very aware and conscious of diversifying out of it. So not only home country bias in terms of the stocks and the bonds you buy, but also the currency. And I think it's now a really important time that people think about how to get all of that, the opportunities that they may have missed in other parts of the world, especially parts of the world that are, reopening and making it very interesting.
Morgan Stanley's James Gorman agreed that there is room for optimism, not least because of China.
Well, I've seen a lot of cycles in my career, and I've seen some really, really dark periods. The financial crisis after September 11, Even though, the early recessions in the US in 93, 94, the market bust in 87, I go back, I'm a lot older than you, I go back a long way. And, I think what we've been through, if you stack up the negative stuff that happened, first land war in Europe in 70 years, first global pandemic in a century, and highest rate increase because of inflation in 40 years, that's a lot to throw at people. And where are we now? It's not bad. The debate is, will it be a recession? Will it be short and shallow? Nobody's saying we go into depression, right? Everybody's saying we can kind of deal with this. And two things I think have changed in the last month, which has caused this echo chamber we live in here in Davos, where everybody's basically repeating back to each other what they've heard from the last person. Let's be honest. I'm not, hopefully, but most people are. Two things have changed. Number one, the inflation numbers are there's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Bank of America Chief Brian Moynihan agreed with others about the likelihood of a recession, but at the same time it not being too severe, based on the strength of the consumer and also the strong labor market.
In the U.S., our research team, which is the best in the business, has a mild recession predicted sort of mid this year into next year. They push that out, and so why they keep pushing out? It's the strength of the U.S. consumer. They have the Fed getting over 5%, 5.25%. Just this week, they moved that to 325 basis point rate rise as opposed to 50, meaning again the Fed can slow down a little bit because you're seeing inflation go over. And so that's what we have. And so this year ends up being positive, next year ends up being positive, but you have a little trough in the middle, and that really is reflective of what you saw this morning. Employment's still strong. People are working. They're getting paid more, but they've got to get to inflation, so they have to keep the rate structure up here for a fair amount of time until they get the services side inflation down. And the market may be misreading how fast that will take. But on the other hand, we're a heck of a lot better shape than all these other economies that I talked to out here.
That's for sure. So pushed out the possible recession, your research team did. Is it also looking shallower because the economy is more resilient than we thought it was? Well,
the consumer is very resilient, and look, new claims for unemployment were down enough 190,000 before the 2007-8 recession, Great Recession, financial crisis. They ran 330,000 each posting. So think about that difference in the workforce, about 20% bigger. These are down to numbers consistent where they were in 50 years ago when the workforce was half as big. So the employment's still strong. Now, are we all being more careful about hiring? We're all trimming our head count by attrition. Are we all flattening out? And some industries are actually taking head count down. So that may change, but it hasn't changed yet. The money in their accounts is still there, and it's come down a little bit. They're starting to spend it, but on the other hand, it's multiples of where it was pre-pandemic. They have lots of borrowing capacity. Now, what's quickly stopping? Obviously, mortgages got expensive and house purchases stopped, but the dollar value of housing that shot up after the recovery, yes, it's come down, but still way above where it was in 19. And so people have to think about this in the perspective of long-term growth rates that fell and then shot up with all the stimulus and now are settling in. And the Fed has to bring inflation down because inflation will eat away at purchasing power, and that's really not good for especially median income households.